A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
My Weird Prompts is a community-driven initiative exploring how AI can fuel curiosity and uncover the fascinating ways our world works. GPU compute for this podcast is generously provided by Modal. Learn more at modal.com.
Herman, most people think of a family office as a small administrative team managing trust funds and polo club memberships. It is an outdated, old money image. But if you look at the data coming out this month, that view is no longer accurate. We are talking about a $5.5 trillion shadow economy that is currently displacing traditional investment banks and private equity firms.
The scale is unprecedented. It is not just the size that is changing, it is the fundamental nature of how this capital moves. We are moving away from the era of passive wealth preservation. These are no longer just passive accounts for the ultra-wealthy. Today's family office is a high-speed, AI-enabled institutional dealmaker that operates with more agility and significantly less oversight than almost any other entity on Wall Street. As of today, March 24, 2026, we are seeing these entities move from the sidelines directly into the center of the arena.
Today's prompt from Daniel is about these very entities. He wants us to define family offices, explain their role in the broader financial system, and examine their risk appetite. He is also asking if they are just high-end private bankers for old money families, or if there is something more sophisticated going on.
Daniel's timing is perfect. We just saw the 2025 FINTRX Family Office Industry Report drop yesterday, March 23rd, and it confirms where this is going. Herman Poppleberry here, and I have been reviewing these numbers all morning. The biggest takeaway is that these offices are becoming their own ecosystem. They are bypassing the middleman entirely. They are not just participating in the market, they are becoming the market.
Let us start with the basics. When we say family office, we are talking about a private wealth management firm that serves families with at least $100 million in investable assets. A single-family office, or SFO, serves one dynasty. A multi-family office, or MFO, pulls a few together to share the overhead. The key difference between this and a private bank is the fiduciary role. A bank sells its own products, like mutual funds or structured notes. A family office is the family's own chief investment office. They are the orchestrators.
That distinction is where the reality sets in. If you are a billionaire, you eventually realize that the big banks are often extractive. They charge fees to put your money into funds that charge more fees. The modern family office is the direct response to that. If you have enough capital, you can hire the professionals who used to run those bank funds, bring them in-house, and keep the upside for yourself. Over 50% of active family offices were founded after 2010. This is a new money phenomenon driven by tech exits and the massive wealth creation of the last 15 years. It is less about old money and more about new power.
Why be a client when you can be a competitor? Let us look at the risk profile. Most people assume that if you have $1 billion, you are playing it safe with bonds and gold. But the Goldman Sachs data for 2025 and 2026 shows the opposite. They are heavily risk-on. We are seeing average allocations of 31% in public equities and a staggering 42% in alternatives, like private equity, real estate, and private credit.
That 42% in alternatives is the real story. That is where the aggression lives. They are not just buying stocks, they are buying the companies themselves. 70% of family offices are now doing direct deals. They are looking at a healthcare startup or a logistics firm and deciding to buy 40% of the equity themselves rather than using a private equity fund. Because they do not have outside limited partners to answer to, they can hold that position for 20 years. They have no exit pressure. They do not have to sell a winner just because a fund's 10-year clock ran out.
That lack of exit pressure is a massive competitive advantage. A traditional private equity fund must return capital to investors in 7 to 10 years. They are often forced to sell, even if it is a bad time for the market. A family office can sit on a company through a recession and wait for the recovery. Despite all this talk about being cutting edge, 72% of them hold zero gold and 89% hold no cryptocurrency. They're not interested in speculative hedges. They want tangible, cash-flowing assets or high-growth tech. They are betting on the future.
They are betting on the Magnificent Seven tech stocks and private debt. It is a pro-growth stance. What is really changing the game right now is the technical execution. There was a Bloomberg roundtable on March 12th where principals discussed using AI-driven analytical agents to vet these direct deals. We are talking about taking a complex private equity-style due diligence process that used to take 3 weeks and compressing it into under 30 minutes.
Wait, 30 minutes? Herman, that sounds like a recipe for a disaster. You cannot understand the deep risks of an operating business, the culture, the supply chain, the legal liabilities, in 30 minutes, even with a sophisticated large language model. Is this just tech hype, or are they actually finding alpha there?
It is about the first filter. These AI agents are not making the final investment decision, but they are scrubbing thousands of pages of documents, legal filings, and historical financials to find the red flags immediately. If the deal passes that 30-minute scrub, then the humans step in. But it allows these offices to look at 10 times more deals than they could 2 years ago. They are becoming high-frequency deal hunters. This is why the institutional world is concerned. They are faster, they have cheaper capital because there are no management fees, and they have an infinite time horizon. They are essentially bypassing the 2 and 20 fee structure of the hedge fund world. Why pay a fund manager 2% of assets and 20% of profits when you can pay a salary to a team of experts who work only for you?
It sounds like they are becoming unregulated hedge funds owned by one family. If they are so sophisticated, why is the geographic landscape shifting? The FINTRX report showed North America's share of new family offices drop from 68% to 49% in just 1 year. Europe and Asia are growing rapidly. Is that a reflection of where the wealth is being created, or is it a regulatory flight?
It is both. Asia is seeing a surge in first-generation wealth from the tech and manufacturing sectors, and those families are going straight to the family office model. They are learning from the mistakes of the West. In North America, we are seeing a maturation. The real growth now is in secondary markets where the regulatory environment is still being shaped. A lot of this is also about tax optimization and privacy. As the world gets more volatile, the ultra-wealthy want their capital in structures that are harder to track.
You mentioned volatility, and that brings up a contradiction. The JP Morgan report from February 10th says 64% of these offices cite geopolitics as their top risk, yet they are still heavily invested in these high-risk alternatives and direct deals. How do you square that? If I am worried about the world being on fire, I usually move to cash, not to a direct stake in a mid-sized logistics firm in an emerging market.
Because they realize that in an inflationary or volatile world, owning the underlying assets is the only real protection. Cash is a guaranteed loser when the currency is being debased. They are leaning into the infrastructure of the world because they believe that even in a crisis, people still need healthcare, shipping, and data centers. It is a practical worldview. They are not betting on peace, they are betting on utility. They are buying the plumbing of civilization.
That is a direct way to put it. But there is a weak link here, and that is succession. The UBS 2025 report says 53% of these offices have no formal succession plan. You have sophisticated AI and former hedge fund managers running the show, but the entire thing is still tethered to the life of one principal. What happens when the founder dies and the heirs, who might not have the same risk appetite, take over?
That is the trillion-dollar question. We are in the middle of the great wealth transfer. We are talking about $124 trillion moving between generations through 2048. A lot of these family offices may struggle because the second generation wants to do impact investing or buy art instead of running a sophisticated private credit book. There is a tension between the institutionalized professionals hired to run the office and the heirs who want to change the mission.
We touched on this dynamic in episode 1421 when we talked about private high-tech bunkers. It is the same mindset of creating a parallel private infrastructure that is separate from the public markets. These families do not trust the banks, they do not trust the traditional funds, and increasingly, they do not even trust the public markets to reflect true value. They want to own things directly where they have total control.
And that control is the primary motivator. When you are a client of Goldman Sachs, you are just a number. When you have your own family office, you are the boss. You can tell your deal team to pivot into AI infrastructure on a Tuesday morning and have a term sheet out by Friday. You cannot do that in a traditional institutional setting, but the downside is that the risk is concentrated. If that one family office makes a massive bet on a sector that goes bust, there is no one to bail them out. They are the lender of last resort for themselves.
I want to push back on the perception of them being fancy private bankers. If you look at the hiring trends, they are hiring the most aggressive talent from the top-tier firms. Mina Flynn, the co-head of Global Private Wealth Management at Goldman Sachs, has been vocal about this trend. If you were a star at a major hedge fund, why would you stay there and deal with the stress of external investors and regulatory filings when you can go work for a single family, get paid a massive salary, and have a direct line to the principal?
It is a brain drain. The institutional world is losing its best people to these private entities. Because these offices are private, they do not have to disclose their holdings in the same way. We are seeing the rise of a parallel financial system that is increasingly opaque. The $5.5 trillion we talk about is just the estimate. The real number could be significantly higher. These are the entities that are actually moving the needle on things like the Magnificent Seven stocks. When people wonder why certain tech stocks seem to have a floor that never breaks, it is often because these family offices are sitting on them with a 20-year time horizon.
It is the institutionalization of the individual. Let us talk about the AI piece again, because the JP Morgan report said 65% of these offices say they want more AI exposure, but they lack the infrastructure. That seems like a massive opportunity for the tech sector. They have the money and the desire, but they are still running on legacy systems in many cases.
You have a family with $2 billion, and they are still using spreadsheets from 2012 to track their private equity holdings. There is a gap between their investment goals and their operational reality. This is why we are seeing a surge in fintech platforms specifically targeting family offices. They need a custom tech stack that can handle direct deals, tax optimization, and AI-driven due diligence all in one place. If you can solve the infrastructure problem for these offices, you are sitting on a major commercial opportunity.
It is a paradox. They are sophisticated enough to bypass the banks, but often too disorganized to manage their own data. But if they do solve it, if they get that AI layer right, they become very powerful. They have the cheapest capital, the longest time horizon, and the best talent. What is the end game here? Does the entire financial system just become a collection of private family offices trading with each other?
We are already seeing the beginning of that. It is called the direct deal secondary market. Family offices are now trading stakes in private companies with each other, completely bypassing the stock exchange and the investment banks. If this continues, the public markets will eventually just be the leftovers. The real value and growth will stay private for longer, managed by these elite family units. It is a return to a sort of neo-feudalism, but with better software and more liquidity.
That fits the data. It is a consolidation of power that is insulated from typical market pressures. Let us look at the impact investing side of things. Daniel mentioned that the great wealth transfer is forcing a pivot toward ESG and digital assets. We talked about the rules of impact investing in episode 439. Do you think that is a genuine shift in worldview, or is it just the second generation trying to feel better about their inheritance?
In many cases, it is reputation laundering. When you have that much wealth, you need a narrative that makes it acceptable to the public. Impact investing is the vehicle for that. You can still make a profit, but you can frame it as saving the world. Now, are there families who genuinely care? Sure. But the primary driver of a family office is the preservation and growth of the family's power. If ESG helps them do that by giving them better access to certain markets or better public relations, they will do it.
It is a pragmatic move. If the world is moving toward green energy and social responsibility, you want to be positioned there to make money. But it does change where the capital flows. If these $5.5 trillion start moving toward impact projects, it has a massive real-world effect, regardless of the motivation.
The motivation matters less than the scale. If family offices become the primary source of capital for infrastructure and green energy, they effectively become the primary influencers of the future. They are deciding which technologies get funded and which cities get built, and they are doing it behind closed doors.
So, to answer Daniel's question, they are definitely not just fancy private bankers. They are more like private sovereign wealth funds. They have the same level of sophistication and scale, but they are accountable only to a few individuals. That is a level of concentrated power that I do not think the average person has even begun to wrap their head around.
It is the ultimate evolution of capitalism. The individual has become so wealthy that they no longer need the structures of capitalism to function. They have built their own. And with the projected growth to $9 trillion by 2030, this is only the beginning. We are going to see more former heads of state, more top-tier scientists, and more elite engineers being hired directly by these families.
It is a strange world when a single family can have a better intelligence gathering and investment team than a medium-sized country. Let us pivot to some practical takeaways, because for our listeners who might be dealing with these entities or working in the sector, there are some clear trends to watch.
First, the direct deal is the primary objective. If you are a founder looking for capital, a family office is often a much better partner than a traditional venture capital or private equity firm. They are more patient, they are less bureaucratic, and they can offer the family's entire network. But you have to be able to pass that AI due diligence scrub. You need your data in order.
Second, the succession risk is real. If you are looking at a family office as a partner or an employer, you need to look at the second generation. Is there a plan? That 53% number from the UBS report should be a red flag for anyone in this space.
And third, the infrastructure gap is the biggest opportunity. There is a desperate need for technical talent within these offices to build the stacks that can actually leverage the AI they are so eager to use. If you are a developer or a data scientist, do not just look at the big tech firms. The family office space is looking for people who can build private, secure, high-speed investment platforms.
It is a lopsided landscape. We are moving toward a world where the most important financial decisions are made in private rooms by people we will never meet, using data we will never see. It is the death of the bank as we know it, and the birth of something much more personal and much more powerful.
And it is all happening right now. The shift in the last 2 years alone has been faster than the previous 20. The integration of AI into these private structures is accelerating the gap between the ultra-wealthy and everyone else. They are not just wealthier, they are becoming more efficient at being wealthy.
That is a sobering thought to end on. They are optimizing the very nature of wealth itself. But that is the reality of the 2026 financial landscape. It is private, it is fast, and it is increasingly automated.
It is a wild time to be watching these numbers. I think we have hit the core of what Daniel was looking for. These are not your grandfather's wealth managers. They are the new power players of the global economy.
Definitely. Well, I think that covers it for today. This has been a deep dive into the shadow world of the family office.
Thanks to our producer Hilbert Flumingtop for keeping the gears turning behind the scenes. And a huge thanks to Modal for providing the GPU credits that make this whole show possible. We really could not do this level of analysis without that horsepower.
If you enjoyed this episode, search for My Weird Prompts on Telegram to get notified the second a new episode drops. We are also on Spotify and Apple Podcasts, so make sure to follow us there if you haven't already.
This has been My Weird Prompts. We will see you next time.
See ya.
This episode was generated using Gemini Flash 3. Text-to-speech engine was Chatterbox.
Thanks for listening to our show, My Weird Prompts, where our thoughts go from slow takes to facts on cue. We change and follow through. My Weird Prompts, that's the close from sloth